are the question. Okay, these are the question. I hope I have made a necessary adjustment. So if there are still some error or mistake, uh, I, I will basically correct it, but I think it's already okay. Okay, so let's look into the first question. Okay, so this is just some data with regards to Mr. Ahmad. Okay, employment in XYZ Sendirian Berhad. Mr. Ahmad has been employed at the age of 50. Okay, at the age of 50. So normal retirement age is 65 years. Okay, so that means Mr. Ahmad is expected to, if he's expected to retire at the normal age, so it will be 15 years, 15 years in service. Okay, so of course, it just says that service earned each year. That means after completion of every service year, then Mr. Ahmad will basically earn some of the benefit, okay, provided by the company. Annual investment return, this information might be useful, okay, to calculate for the contribution, okay. So we have discussed previously when we talk about benefit plan, okay, sometimes or most of the time company would make some contribution in order to ensure, okay, in order to ensure whenever they need to basically pay their employees the benefits, they will have enough or adequate funds. Let's just assume the next is a table, just assume, okay, for the next 15 years. Okay, so this is the data. Okay, this is the data about Mr. Ahmad annual salary for the next 15 years. Okay, so it started from 51. Okay, of course, Mr. Ahmad was employed at the age of 50. So completion of the first year, that's mean at that time when Mr. Ahmad complete his first year of service, his age will be 51. Okay, so then on the next column, you are provided with the annual salary of Mr. Ahmad for each year until he retire at the age of 65. Okay, so that is what has been provided. Okay, now we look into the question. Okay, so there are two requirements here. The first requirement is basically referring to defined contribution plan. Okay, defined contribution plan. I think by now you should be able to differentiate what is the meaning of defined contribution plan and what is the characteristic of a defined benefit plan. Okay, so here, the characteristic of defined contribution plan is basically the employer will pay fixed contribution, okay, toward their employees. Okay, so here the employer have basically promised Mr. Ahmad they will pay 3%, okay, per year on 3% on the salary of the employer to all the employees, okay, or to all the participants to this to this employment plan, okay, employment benefits, 3%, and they will match, okay, they will match. This is just, I think the idea is just for you to think lah, okay, to think, okay. The company or the employee will pay 3%, and then they will add up, okay, they will add up another 50% of the first 4% contributed to the plan by the employees or the participant. So if you assume Mr. Ahmad contribute 6% per year, that means of course 6% is higher than 4%. The employer will add 2% more, okay? Because 50% of 4% is basically 2%. So the basic employer will contribute 3%, and then they will up another percentage by matching 50% of the first 4%. Okay, so of course, Mr. Ahmad contribute more than 6%, so the company or the employer will match additional 2%. Let us assume another employer, for example, assume let's say Mr. Ali. Okay, Mr. Ali only contribute from his part. Okay, from his contribution only contribute 2%. Okay, so only contribute 2%. So the employer or the company will only add another 1% because 50% of 2% contribution by Mr. Ali is an additional 1%. So in that case, for Mr. Ali, the employer will contribute 4% because it will only add one additional percent. Okay. However, for Mr. Ahmad, since Mr. Ahmad contributes 6%, so they will match 50% of the 4%. So that is an additional 2%. So in total, the employer will pay 5% to Mr. Ahmad. Okay, so that is, I think, the only issue which might require to think a bit more. Okay, because defined contribution plan is a very straightforward calculation. Okay, so I think that is where um, a further think or a more in-depth think, okay, need to be given. Okay, need to be given because you need to know how many percent the employer contribute to their employees. So once you get that, that's mean in this case, the employer will pay 5%. Okay, 5%. So once you get that 5%, I think there will be no problem for you to calculate. For example, here, what would be the Mr. Ahmad account balance at the age of 55, or at the age of 60, or at the age of normal retirement? Okay, let me share you the solution here. Okay, so if you look into the solution here, column C is the most important. Okay, column C is the most important because you need to know how many percent is the contribution by the employer to Mr. Ahmad. Now we have sought out, that is 5%. So once you get that 5%, then it should not be any problems. Okay, it should not be any problems. Okay, so if you look here, so contribution will be 5% of the salary of the employees. So 5% of, for example, for the row 51, age 51, so salary is 50,000. So 5% of that is 2,500. That means employer will contribute 2,500. Okay. Assumption is contribution is always made at the end of the year. Okay, at the end of the year. So that's why the balance is also 2,500. Okay. For age 52, so how much employer will contribute? Again, that is a very straight calculation. It's 5% of the salary. So 5% of the salary is 5,000. Sorry, 5% of the salary, which is 52,500, is equivalent to 2,625. Okay, 2,625. But how do you get this balance? Okay, so of course, whatever openings balance which you have, okay, you can invest. Okay, so for example, the first year contribution of 2,500 is basically could be invested, and that could make the balance of Mr. Ahmad account grow. Okay, so if you look into the question at the beginning before the table, the assumption of the expected return is 5%. So that's why when you click this cell, okay, you see the formula here, D5. D5 is the openings balance. Okay, D5 is the openings balance, and you multiply by 1.05 because you are expecting a return of 5%. Then only you add the annual contribution by the employer. So that is C6. Okay, the current year contribution, and then you will get the balance. Okay, of Mr. Ahmad. This is the portion of the the portion of the employer. Okay, the portion of the employer. Okay, so then you can just work out, okay, continuously work out, okay, contribution by the employer. So whatever balance in the second year, then you could invest, and then that could also give another return, okay, of 5%. Okay, so that is how you do it. So if the question asks you what will be the balance at the age of 55, then you just look into the row age 55, and then you will get the balance, okay, in terms of the contribution by the employer. So if it's at the age of 60, then you just refer to the age of 60, and then finally at the normal retirement age. Okay, and I think we have basically discussed in terms of the accounting treatment due to the nature of fixed contribution by the employer in the defined contribution plan. So accounting treatment is straightforward, just like how you treat the short-term employees benefit. So we'll just recognize it as expenses and liability. Okay, so that is the first question with regards to the employer fixed contribution toward their employees. Okay, so that is the first question. Okay, I think this one is quite straightforward. I will just continue with the second question. Then I will
So
stop. Okay, yeah,
before
yeah.
that, can you explain back the match percentage? I'm quite unclear on that.
Oh, the match percentage is if the employees, okay, if the employer will only match the first 4%. So that's mean if the employees contribute either 4% or 5%, 6% or 7%, it will only match the first four. That's mean if the employees contribute 4 and above, okay, the employer will not match according to the percentage contributed, okay, by the employees lah. Okay, for example, even if the employees contribute 10%, it will only match the first four. That is the maximum lah the company will add. However, if it is lower, okay, if the employees contribute lower, okay, than 4%, like 2%, then of course the employer will only match 2% because the employees only contribute 2%. So if it is lower, then you will use the actual percentage lah, contributed by the employees and match 50%. So if it is 2%, match 50% of 2%. Okay. So if it is lower, then you will basically match the actual. Okay. If it is higher than 4, the cap is only at 4%. Is that clear?
Wait,
Okay.
the one that you said will add 2% more,
Uh-huh.
and that one,
Okay.
well, where
For
is it being used?
so for employees, because employees also have their own contribution. Okay, employees also make their own contribution. So for those employees who contribute 4 and above, then the company will match an additional 2% more, because 50% out of 4% is 2%. So it will add up 2%. But for employees which contribute less than 4%, then the employer will only match 50% of the actual contribution by the employees. Is that okay? Still a problem?
So
Sisters?
that's where the 5% comes in.
That's where
Is
the
it?
3% is basic. That means 3% employer will pay to all. Okay, employer will pay to all their employees. 3% is already fixed. Okay, already fixed. But then there will be an additional percentage depend on the percentage contributed by the employees themselves. So it will match that. Okay. So Of course, the most if you can go is 5%. The most you can go 5% because the employer will only match 50% of the first 4%. So that means the most you can go is an additional 2 more percentage. So that is where you get 5%, 3 plus 2. But of course, if the employees contribute lesser than 4%, then it will be a bit lower lah. It will be more than 3, okay, but the maximum is capped at 5 because it cannot go more than 5 because the employer will only match 50% of the first 4% percentage contribution contributed by the employees themselves.
Okay, got it, sir. Thank
Is that
you.
okay? Is it
Yes,
okay?
yes.
Okay.
Thank you.
Okay. So that is what it means because I think other than that, it is very straightforward. Okay. For defined contribution plan. So that is where I think actually I take this question from I cannot remember from where, but I think when I read at first I already thought that this is where it requires a deep understanding lah. Because if you get the percentage wrong, and then your calculation will be wrong. Because other than that, it will be very straightforward. Okay. So, is there any more questions?
Sir.
If no, oh yeah,
Sir,
yep,
the 5%
Yeah.
annual investment return,
okay.
5%. In the question, that one is we have to calculate, or that one memang given?
It's actually given at the top of the question. Where is the question? It's actually given at the top. At the top of the question. Here,
I can.
annual
But
investment return 5%.
so where is that being used in the answer?
Oh, where it is used? You need to look into my formula because I just write in my formula. So you
The
see
one
here,
in
my
balance contribution, is it?
So when you click the
Oh,
balance in the contribution, you see D5 is the opening balance.
okay.
And I
Okay, got
multiply it by 1.05. So the 05 is the return. Because the assumption is contribution is made at the end of the year. So your return will only come from your opening balance. Okay? Got it?
Okay, thank you.
Okay. Okay. Now we go to a bit more difficult issues
Sir,
because we will talk. Yeah, okay.
can
Yep.
you repeat if the employee contribute 2%?
Can I repeat the employee?
If the employee contribute 2%.
If the employees contribute 2%, so the employee will only match 50% of from that 2%. So that means the employer will only add one more additional percentage
Okay.
because of 2% is only 1%. Okay?
Okay. Thank you.
Okay. So the example which I say, let's say Mr. Ali only contribute 2%. So for Mr. Ali, employer will only pay 4%. For Mr. Ahmad, employer will pay 5%. Okay? Okay. So now we look into question on defined benefit plan. So question number 2 from the first question is about defined benefit plan. Okay? The characteristic of defined benefit plan is the employer have not fixed any amount, okay, but have agreed, okay, but whatever amount, okay, which will basically derive from this formula calculation, the employer agreed to pay to the employees, but the amount itself have not been fixed, okay, have not been fixed to certain amount, like whether it is 10,000 or whether it is 25,000. It's not fixed, okay, it's not fixed. Okay, so you need to calculate first, and the formula is basically here is 5% of the average compensation. So that will give you annual benefit, and of course multiply by the number of years in service. Okay, by the numbers of years in service. So annual benefit will be 5% of the average compensation. Okay, and of course multiply by how many years you have been in service. And this plan is only become liable, okay, obligated for the company if the employees complete 5 years in service. So that means if the employees retire before the completion of 5 years in service, then this benefit will not be given to the employees. So that means it only become obligated to the company, okay, if employees complete his the first 5 years in service. So if companies expected employees to always complete the 5 years and go up to the normal retirement, then of course they need to basically if that is their assumption, they need to basically record. So I think the assumption is, okay, the assumption is employees will be able to basically complete the first 5 years unless it's proved that the employees is basically retire before that. Okay, so our assumption is we just assume that the employees will go through, okay, until the normal retirement age. The other complication here is the average compensation calculation here is basically calculated, okay, as the highest average using 5 consecutive annual salary. I will show you in the answers, okay, in the answers, okay. So this is the answers. The calculation of average compensation is basically here, okay, the one which I have blocked, okay. So of course you can only calculate the first average after 5 years, okay, because you need to calculate the average according to 5 consecutive salaries, okay, 5 consecutive annual salaries. For example, okay, at the age of 55, then you will be able to calculate the first, okay, the first average figures, and that's that 5 years have a unique understanding, because that is why the policy of the company is basically to only give the benefit to those who have completed the first 5 years. Okay, so that's why I think the formula of calculating the average align to that policy of the company. So that is where you can calculate the first average. So how you calculate the average at the age, okay, at the age of 55? So of course you will add the 5 consecutive salaries from the age 51 until 55. Okay, so you add from 50,000. Okay, then you add 52,500. Then you add another 55,000, 55,500, and then 58,000. That is where you get that figure. That is a total salary for 5 years. Okay, total salaries for 5 years, 271,000. And if you divide by 5, that the average salary at that point is 54,200. Okay, then when you move 1 year further, okay, age 56, then your calculated of average salary will be 5 consecutive year. That's mean from 52 until 56. So that is 5 consecutive years. So the total from 52 years until 56 is 278. So if you calculate the average, you will get 55,600. Okay. So you move forward. So you move 1 year, the 5-year average, okay, or the 5 years average will also move by 1 year. Okay. So that is how you get the average for every year from 55 years until 65. Okay, so that is first calculation, how to get the average. Okay, how do you get the average? So if you are expecting that the employees will retire at the normal retirement age of 65, so you have many average, okay, average salaries here. Okay, so which one should you use in the calculation, okay, in the calculation of the employees benefit? Okay, which one should you use? You should use the one which is the highest for the calculation. Okay, so doesn't mean that the last year average is the highest, because in this calculation the highest average is 1 year before retirement. So I have basically highlighted it in bold. Okay, this one. So when you calculate the benefit to the employees, assuming, okay, assuming that the employees, okay, the employee will retire at the normal retirement age, so you need to look until the age of 65. So which is the highest average? So 69300. So depend. So if, for example, the question just asked at different point, if it will retire at the age of 60, then you just look the average until the age of 60, which one is the highest, and that's one you will use in the calculation of the benefit to the employees. Stop there for a while. Is that okay? Is that confusing?
So
Uh,
why
Yep.
is 62500 also bold in bold? Is
Because that is
error?
no error, because in the question there is also one question asked what would be the benefit at the age of 60. So that's why if I just stop at the age of 60, that will be the highest. Okay, that will be the highest. So if I assume until normal retirement age, which is 65, then the highest will be 69300. So I also bold 62500, but I don't put highest average over there, because in one of the question is basically assuming, okay, assuming that the employee will retire at the age of 60. So then you need to use this highest average of 62500 for the calculation. So if you look into the question here, because it just asks you at few point, okay, what is the average compensation at normal retirement? So that's one, the one which I put highest average, but it also say what will be the average compensation at the age of 60. So that's why I also put the other one, which is 6 to 500. So because there are two set of a question here, A and B is asking at the normal retirement age, C and D is asking at the age of 60. So the second one, which I have bold, is basically to answer C and D. So that is the explanation for 6 to 500. Okay, sisters? Brothers? Okay, brother, do you have any question? Brothers? Always sisters who are asking? Okay, so that is basically some complication lah. Okay, but I think the source of the question which I take, it is, I don't know why you make it a bit complicated, but for final might be a bit much more easier lah than this. Okay, than this. Okay, so that is how I explain the highest average. When you get that, that will not be any problem. Okay, so you already know the highest, what will be the highest average at normal retirement age, 69300. So how the benefit is calculated is 5% time that highest average. So that is equivalent to 3465. This will be the annual benefit, and the employee will earn this for all the years which he have provided service to the company. So if the employee have provided 15 years in service, like in this case, Mr. Ahmad have provided 15 years in service. That means he will earn this 3465 for 15 years. That means you just multiply it by 15, then you will get the total benefit to Mr. Ahmad. But if another employee just retire at the age of 60, then the company will use the highest average of 6 to 500. This is question C and D, and then calculate how much is the annual benefit for this employee. 5% of 6 to 500 is 3125. Okay, and then the employees will earn this for all of years in service he has provided to the company. So if you are assuming also this employee start working at the age of 50 and retire at the age of 60, that is 10 years. Okay, so that is how you calculate the average compensation in this question and the annual benefit earned at normal retirement age. Okay, so that is quite straightforward to the figures in the table. Okay, so now let us assume that Mr. Ahmad is expected to retire at the normal retirement age. So that's mean Mr. Ahmad will earn every year 3465. Okay, 3465. That's mean once Mr. Ahmad, because we are assuming Mr. Ahmad will retire at the age of 65. So once Mr. Ahmad complete his first year of service, he has earned the first 3465. Okay. So then it will earn another 3465 every year until he retire. Okay, until he will retire. So the question is just asking. Okay, so that's why you can see here I put at the age of 51. Okay, Mr. Ahmad earned 3465, 52 another 3465. Okay, until I think actually until the age of 65. But the question just asks, what would be the value of the defined benefit obligation the company need to recognize? So whatever benefit earned by the employees, the company need to recognize that as part of their obligations. But the issue is Mr. Ahmad will only retire at the age of 65. Okay, so that benefit is at the age of 65. That only will basically be paid. So once Mr. Ahmad complete his first year of service, Mr. Ahmad age is only 51. Okay, is only 51. He has earned, okay, the first year benefit of 3465, which is expected to be paid in 14 years. Okay, in 14 years when he retire at the age of 65. So this is where you need to basically use discounting process. So this is what we have called what is the word they use? I also forgot. The method, as in the accounting standard. Normal layman term, this is what we says discounting approach. What? Astaghfirullahaladzim. I also forgot. Credit. Do you anybody remember? Projected unit credit method, if I'm not mistaken. Projected unit credit method. But what is more important, this is what we mean by discounting, because okay, the benefit is would only be paid at the age of 65. But at the age of 51, when Mr. Ahmad complete his first year of service, he has earned this, and company need to basically recognize this as a part of his of its obligation. So that's why you need to discount. So that's why the next column here you can see a discounting process. Okay, you need to discount the 3465. Okay, at the age of 51, you need to discount present value. Interest is given as 5%. The end is 14 years, because from the end of year one, which is at the age of 51, until age of 65, that is 14 years. So that's why you need to discount and equal to 14. So as you move further, of course, the end will reduce, okay, by 1 year. Complete the second year, Still you need to discount, but the N is equal to 13. Go further, at the age of 53, the N now become 12. At the age of 54, the N now become 10. And the age of 55, the N is equal to 10 because there is 10 more years until the age of normal retirement of 65. So I just look into the table, present value, single factor. Okay, so this is the factors which you need to use. Okay, so the next column is the factors derived from present value table. So the present value amount is the last column here. Okay, so the last column here. So for each service cost for each respective year, the discounted or the present value amount is calculated in the last column here. And then of course, if you want to get the total amount of obligation at the end of the year, so you just use the same table, the same process as has been illustrated in example 4.11, if I'm not mistaken. Okay, so current year service cost, this is the first year. Of course, there is no interest, and assumption is always you recognize it at the end of the year. So whatever opening balance will be subjected to interest 5%, and then you will have an additional current year service cost which need to be recognized as part of the obligation of the company. So we just continue that. So if you stop at the age of 55, the amount of obligation is equal to 10,642.19. Okay, so that is the explanation. I know that there will be a question. So any question you would like to ask? So this is the answers for the second question. Okay, the second requirement in the first question. Any questions? Brothers? Brother? Sisters, do you have any questions? Do you have any questions, sisters?
No, sir.
Are you okay?
Okay, okay.
Yes, sir. Okay.
Okay. Are you okay? I hope okay. Of course, you can try again. We will still have I think 2 more meetings next week. Okay. So if you have any questions, please ask again. Okay. So this is one type of the question. Okay, which could be asked. And then just want to share with you another type, okay, of question here. Usually I also sometimes ask this kind of the questions, okay. So I think the issue is like illustration, okay. It's like illustration, like the illustration which had been given before, okay. For example, here I just put IIUM employed a professor on a contract basis for 5 years. Okay. Of course, at the end of completion of 5 years contract, the professor has been promised with a gratuity. Gratuity is a lump sum payment upon retirement. Okay. Gratuity is a lump sum payment upon retirement. Pension is different. Okay. Gratuity, one lump sum payment, finish. Okay. But pension is different. Okay. Because pension will be paid monthly after the retirement until the retired employees pass away. Okay. Pass away. So that is a bit more complicated. But gratuity is much more easier because it is a lump sum payment. Okay, it's a lump sum payment. So of course we have not tried to illustrate using pension because pension is much more complicated. Okay, much more complicated to calculate because you need to make an accurate assumption about, for example, you retire at the age of 60. How long will basically be alive after retirement? That is not easy. Okay, that is a very difficult assumption or calculation. Gratuity is easier. When retired, you will get this one lump sum payment, and this lump sum payment is calculated of 15% of his final salary multiplied by the number of years in service. Okay, multiplied by the numbers of years in service. So looks very similar. Okay, to the previous question, but one issue here is, of course, you need to estimate the increase of the salary, the professor salary. Okay, if the professor start his salary with 200,000, so of course you need to calculate what would be his salary upon his retirement. Okay, so the assumption here, the actual assumption here is just assume that the salary will increase 10% every year. Okay, and 10% is also the interest rate. Okay, 10% is also the interest rate. So first calculate the amount of gratuity the professor will receive at the end of the 5 years in service. So actually the calculation is the same, okay, like the previous question. Okay, one which is a bit slightly different is now. Okay, now if IIUM, the employer, would like to ensure that upon the professor requirement to pay, okay, and assuming that the deposit, the employer, which is IIUM, deposit an equal amount of money as a saving every year, okay, and they make the first saving at the end of the first year, which is 31st December 2012, the question asks how much the employer need to save. Okay, how much the employer need to save or need to contribute in order to ensure that when the professor retire, they will be able to pay the professor the gratuity. Okay, so that is the requirement of the question. So let's look into the answer. Okay, so the first part here is to calculate the annual salary of the professor. It started with 200,000 and increased 10% every year. So increase 10% in the second year, you get 220,000. Increase again by 10%, go to 242. 10% again in 2015 is, and then 10% again in 2016. So you get the estimated final year salary for the professor is equal to 292,820. So how much will be the gratuity? 15% of that final salary figure multiplied by 5 years in service. So you will get 219,615. Okay, 219,615. Okay. The issue here is for the second question. You know, you need to have that amount of money when the professor retire, because you need to pay. This is your estimation. This is your estimation, because you know that you need to pay gratuity for the professor upon his retirement. That amount of money, 219,615. Okay. So assuming you contribute equally, okay. So how much would be the contribution every year? Okay. So first issue is, I think you should already understood from your finance subject. This is what we call annuities. Okay, because in equal contribution every year. I think you also know that you have two types of annuity. One is ordinary annuity, another one is annuity dues. Okay, ordinary annuity is basically contribution at the end of the year. Okay, annuity dues is basically contribution at the beginning of the year. So that is the difference. I think this is just a revision. You should know from your finance courses. So now you know that this question is about ordinary annuity. Okay. ordinary annuity because the contribution is made at the end of the year, 31st of December. So that's one, sort out. Okay, so it is an ordinary annuity. Then you know that you need to have a future value 219615. So that is your future value which you need to have. Okay, so that means you need to refer into the future value annuity tables. Okay, future value annuity tables. It's an ordinary annuity, so annuity we just call by annuity. Okay, so we are talking about futures value, which you know it need to be 219615. Now we need to calculate how much is the annual equal contributions. So that's why you need to refer to this table, okay? Future value annuities tables, okay? Future value annuity, okay? So what is the interest rate? Is 10%. So you need to look into the column of 10%. Actually, I think you should know. Okay, this is what you have learned in your finance courses. So you look into the 10% column. How many years? It's 5 years. Okay, it's 5 years. So you take 10% and you look into the row 5, n equal to 5. So what will be the factors which you need to use? Is 6.1051. Okay, so remember that 6.1051. We look back into the answers. Can see here. Okay, you know the amount you need to have in future, 219615. Then you divide it by that factors which you derive from the table, 6.1051. That is equivalent to, that means the company need to contribute every year 35972.38. Okay, 35,972.38. This is the answers. It means company need to contribute every year 3592.38. The table here, which I just highlighted here, just to confirm that your calculation is correct. Okay, that your calculation is correct. So you can see the last figure at the bottom on the left right hand corner. So you will get to 219615 if you contribute every year 35,972.38. So that is how you calculate, okay, for the second part of the question, for question number 2. Okay, any question? This is the 2 questions which I would like to basically share with you today. Okay, for next week's, I'm not sure yet what I will basically share with you. I will inform you. Okay, I will inform you what I will do for the next 2 more classes next week. So this is the 2 questions. Do you have any question, brothers and sisters?
Sir, can I ask?
Yeah. Yeah.
Just now, the 10% of the future value annuity, where do we get it? Because I think the question only mentioned 10% increment of salary.
And the question continue, that sentence continues, says that that is also a reflection of an interest rate. If you read the question properly.
Okay, sure. Thank you.
Okay. 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 Any other questions? Any other question, brothers, sisters?
Sir,
Are you all okay? Yeah.
what is actually the thing that you highlighted in the Excel, like the group of numbers?
Oh, like here in this table, sorry, I stopped sharing. In this table, the one which I highlighted is 35972.38, correct? So that is basically the annual contribution the company need to save. So that is the answers. The next table just try to prove that that answers is correct, because if nothing change, okay, interest rate also don't change. So when you contribute 35972.38, okay, upon retirement, you will have the amount saving is equal to what you need to pay, okay, which is 219,615. So you have enough fund to pay gratuity for the professor. Is that okay, sisters?
Yes, sir. Thank you.
Okay. Any other questions?
Sir,
Okay. Yeah.
sir, the table just now you showed, right? Is it provided in the final exam or we have to find it ourselves?
The future, that future value table will provide that.
Oh, okay. I see. Thank you.
I will provide the necessary table lah. Necessary table. In this case,
Okay.
if you need to use future value table, I will provide you with the future value table.
Okay. Thank you.
But some of you, because you might have learned using financial calculator, so you can also use your financial calculator, no problem. You will get to the same answers. Okay, but for manual calculation using table, the table I will provide for your exams. Okay. Any further question? Let me see the chat. Okay. I think there is no question in the chat box. I don't have also question now online. So maybe what is good is you try again. So if you have any further question, we can still discuss next week. Okay. So I think that is what I have planned for today. So I think that all for today's discussion. Please do it again. Maybe I can also provide maybe 1 or 2 more additional questions for you to practice. Okay. So I think that's all for today. Thank you very much for your participation and questions. Okay. So I would like to stop. Okay. Our discussion today. I will end our discussion by Assalamualaikum warahmatullahi taala wabarakatuh.
Waalaikumsalam. Thank you, sir.
Thank you.